Emma is 34. She lives in Toronto. She works as a software engineer. Her salary, 92,000 Canadian dollars, above the median. Last year, she tried to buy a one-bedroom condo, 700 square feet. Asking price, $680,000. Down payment required, $136,000. 20%. She has $40,000 in savings. It took her 6 years to accumulate. At current savings rates, she will have enough for a down payment in 14 years. By then, she will be 48. She decides not to buy. She rents instead. Monthly rent, $2,100. 41% of her take-home income. Her parents bought their first home in 1987. They were 26 and 28. Combined household income, $55,000. House price, $135,000. Down payment, $13,500. They saved it in 2 years. The ratio of house price to household income, 2.5. For Emma, that ratio is 7.4. This is not a Toronto problem. This is not even a Canadian problem. Michael is 28. He lives in Sydney. He's an architect. Salary, 78,000 Australian dollars. He wants to buy a house. Median house price in Sydney, $1.3 million. 13 times his annual income. His parents bought their house in 1992. Price to income ratio, 4. Lisa is 32. She lives in Amsterdam. She is a graphic designer. Her salary, 46,000 euros. Median apartment price, 450,000 euros. Ratio, 9.8. Her parents bought their home in 1990, 3.2. The pattern repeats across developed economies: Vancouver, London, Auckland, San Francisco, Melbourne, Seoul. What changed? The answer is not greed. The answer is structure. Something fundamental shifted in how housing works, and once that shift occurred, everything else followed mechanically. Rewind to 1985. Housing was shelter. You bought a house to live in it. Property values increased modestly, roughly in line with inflation. The median house in the United States cost 2.9 times median household income. In the United Kingdom, 3.4. Canada, 3.2. Australia, 3.1. Banks offered mortgages, 20% down. 30-year fixed rate. Income verification required. The system was boring, predictable, accessible. Then something changed. Between 1985 and 2005, housing prices in major cities began rising faster than inflation. Not by small margins, by multiples. Vancouver, prices quadrupled. London, tripled. Sydney, similar. San Francisco, worse. The standard explanation: supply and demand. More people in cities. Not enough housing. Zoning restrictions. NIMBYism. All true. But there is a second mechanism, less visible, more structural. Housing became an asset class. In the 1980s, governments deregulated financial markets. Interest rates fell. Credit became cheaper. Mortgage lending expanded. In the 1990s, securitization arrived. Banks no longer held mortgages on their balance sheets. They packaged them into securities, sold them to investors, pension funds, hedge funds, sovereign wealth funds. London, 2005. A trading floor. A portfolio manager examines a prospectus. Residential mortgage-backed securities, American subprime, rated AAA. Yield, 6%. He buys $500 million worth. The mortgages inside that security are loans to people buying houses in Phoenix, Las Vegas, Miami. The borrowers are teachers, nurses, construction workers. They will never meet the portfolio manager. He will never see their houses. The connection between finance and housing is now complete, abstracted, global. This created a feedback loop. More credit available meant more buyers. More buyers meant higher prices. Higher prices meant housing became a lucrative investment. Investment demand increased. Prices rose further. By the early 2000s, Institutional capital began buying residential property at scale, not to live in, to extract yield. In 2012, Blackstone founded Invitation Homes. Over 4 years, it spent $8 billion purchasing 48,000 foreclosed houses in the United States, renovated them, rented them, securitized the rental income into bonds, sold those bonds to pension funds. This was not unique to the United States. In the United Kingdom, pension funds bought entire residential developments. In Germany, Deutsche Annington Immobilien became Europe's largest residential landlord, with 350,000 apartments. In Australia, build-to-rent schemes attracted institutional investors. In Canada, similar patterns emerged. The pattern repeated globally. Housing was no longer just shelter. It was infrastructure for financial engineering. Rental income became predictable cash flow. Cash flow became bonds. Bonds became tradable assets. Assets attracted more capital. Capital drove prices higher. The result, prices decoupled from incomes. By 2024, the median price-to-income ratio reached 12 in Vancouver, 13 in Sydney, 16 in Hong Kong. Even in smaller markets, ratios exceeded 6. The threshold for affordability. 3. If this kind of analysis is useful, you know what to do. But the financial transformation is only half the story. The other half is demographic. Emma is 34. She wants children. 2, ideally. But she does not own a home. She rents a 1-bedroom apartment, 700 square feet. No room for a nursery. She could move to a larger rental. 2-bedroom apartments in her area cost $2,800 per month, 54% of her take-home income. Landlords require proof that rent does not exceed 30% of income. She does not qualify, or she could delay. Save for a down payment, buy a house, then start a family. She chooses delay. Her partner agrees. They will try in 5 years, maybe 7. This is not unique to Emma. In the Netherlands, the total fertility rate dropped from 1.8 children per woman in 2010 to 1.43 in 2023. The steepest decline occurred in regions with the fastest house price growth. A study of Dutch fertility found that rising house prices reduce birth rates, especially for renters, especially for women in their 20s and early 30s. The mechanism is straightforward. Children require space, nurseries, play areas, storage. Space costs money. Higher housing costs delay family formation. In Hong Kong, researchers estimate that 65% of the fertility decline since 1971 can be attributed to rising house prices. The city now has one of the lowest fertility rates globally, 0.9. South Korea recorded a fertility rate of 0.7 in 2023, the lowest globally. Seoul's median apartment, 19 times median income. Young South Koreans call themselves the Sampo generation. Give up 3 things: dating, marriage, children. Italy and Spain, 1.2 children per woman. Both have price-to-income ratios above 8 in major cities. Both have fertility rates far below replacement level. The average age at first birth across OECD countries rose from 28.6 in 2000 to 30.9 in 2022. A 2-year delay may seem minor. It is not. Delayed first births reduce completed fertility. Women who have their first child at 32 instead of 28 have fewer total children. Not by choice, by biology. Fertility declines with age. The window narrows. Between 2000 and 2022, the percentage of women reaching age 40 without children doubled in Estonia, Italy, Japan, Lithuania, Poland, Portugal, and Spain. Childlessness is no longer exceptional. In some cities, it is becoming the norm. This is housing as a demographic constraint. The 2 mechanisms reinforce each other. High house prices delay family formation. Delayed families mean fewer children. Fewer children mean aging populations. Aging populations mean smaller workforces. Slower growth makes affordability worse. And the people who benefit from rising prices are the ones who already own. 65% of households in developed economies own homes. Rising values mean wealth, but those same owners vote to block new construction. More supply stabilizes prices. Stable prices erase gains, individually rational. Collectively, it locks the next generation out. Governments respond with subsidies, tax credits, down payment assistance. Demand increases. Supply does not. Prices absorb the subsidies. Emma is 34. Michael is 28. Lisa is 32. They work, they save, they delay. Their parents bought homes at 26, started families at 28, paid off mortgages by 50. Emma will buy at 48, if prices stop rising, if her income keeps pace, if nothing goes wrong. She will start a family at 50, or she will not start one at all.